Well, welcome everyone. This is our IRS 6055-6056 reporting for 2017. The big reason for this webinar this year is that there have been a couple of changes made. Some of the codes that the IRS used in previous years are now gone, and the forms have changed. So we're going to take a look at those and kind of see everything that's available. Before we get too far started, I do want to let everyone know that we are an insurance brokerage, not tax professionals, accountants, lawyers, anything like that. So the advice you get today is not legal or tax advice. It's basically just our knowledge on things. So keep that in mind as you're filing your forms this year. Today we're going to discuss the different reporting requirements, kind of what the two codes mean, the 6055 to 6056. We'll go over the offer of coverage codes, the safe harbor codes, and we'll look at the forms. So the 6055 requirement is actually for your individual insurance needs. It's basically the individual penalty as it's known. So 6055 tells the IRS that you had insurance through the entire year. Now, if you're in a fully funded insurance policy, typically your Blue Crosses, your United Healthcares, the folks that everybody knows, you pay your premiums, they pay your claims, they're going to do this for you. Now, if you have more than 50 employees, or if you're on a self-funded plan, you'll take care of this via the 6056 requirement that we're going to go over in just a moment. So again, 6055 is really just about letting the IRS know that individuals had coverage for the year so that you don't get hit with a penalty. So for 6056, any employer with 50 or more full-time equivalent employees, or anyone that's in a pool or a self-funded type policy, anything along those lines, you are required to do these forms. Now for this year, you're going to be using forms 1094C and 1095C. The 1095B form is actually very hard to find on the IRS website this year, so it's been an interesting year trying to find all of that. So again, you'll use both C forms this year instead of a B and a C or some other combination that we had in previous years. Anybody have any questions on that, or pretty clear so far?
No questions here.
Perfect. So we're going to go over the different forms here in just a few moments. Now, there are 4 sections of the 1095C form, and really the big ones we need to pay attention to are Parts 2 and Part 3. And that's where all the little codes and numbers and all that fun stuff go into. Now, for this year, all the forms, the 1094C and 1095C, have to be filed by March 2nd with the IRS. If you're submitting 250 more of either form, it has to be done electronically. If you're doing under that, it's up to you if you want to mail them or send them electronically, whatever's easiest for you. So we're just going to give you a quick look. This is the 1094B form. The 1094C form looked very similar to this last year. That form has changed for this year, so this is not a form that you folks are going to be using. This is a form that your health provider would have used to send some of this information out. The form for folks with more than 50 employees or who are on a self-funded or pool plan is the 1094C form. This is a 3-part form. It is a transmittal of employer-provided health insurance offer, so it's basically just a form going to the IRS to tell them how many forms you're sending. The top is going to be your information as far as your group, or, and this says applicable large employer member. If you're self-funded, you basically fall right under that as well. Part 2 shows you how many of these forms are being sent out, and certifications of eligibility if they apply to you. Now that box 22 only applies if you have 50 or more employees. If you have less than 50, you can skip box 22 on this form. Now,
Brandon,
Part 2 of this, yes, ma'am.
Is this 50 or more full-time equivalent employees?
Yep,
or
that is correct.
total?
50 or more full-time equivalent employees.
Okay.
So that does take into account your part-timers. And if that's something you need to figure out, let us know, and we can send out a calculator for you to use. But most payroll companies can also help you determine this pretty quickly.
Thank you.
Mm-hmm. So that's page 1 of this form. page 2 is just the information on how many members you actually had. And again, if you have 50 or more full-time equivalent employees, you're going to be doing this page 2, part 3 information. Now, box 23 would be used for any employer who has a pretty consistent amount of employees running in. We do have some companies where you've got lower paid workers who come in and out, and it does happen, or you tend to train folks and then they move on to other areas. Box 23 probably won't be for you. You'll use box 24 to 35 instead, because this will allow you to know exactly how many full-time employees you have, your total employee count, and that's section B and section C. Here and here. And the other side of this, box D and box E, box D here, would be for anybody who is in an aggregated group. Now, an aggregated group means that you have a single owner who owns multiple locations or multiple businesses. We typically see this for folks that own fast food franchises. They may have a burger chain here, a taco chain over here, and then a sandwich chain over here that are technically 3 separate businesses, but because they're under one employer, they have to count all of those employees collectively to see if they are or not an applicable large employer. Now, additionally on this, you've got this section 4980H transition relief indicator, and we're going to go over those codes in just a little bit to let you know if one of those applies to you and which one you should be using. All right, bear with me. Part 4 is going to be used if you are part of an aggregated group. This lets the IRS know the other businesses that are involved. So you'd put the name of the business and then that business's EIN on this form. So if you own multiple businesses, this is the form you want to use in order to show those counts to the IRS directly. Any questions on our 1094-C?
Not at the moment.
Perfect. Our 1095-C is the form that goes to the individual. Now, when you go to send these forms out, the 94 and the 95 both go to the IRS. The 95 then also goes to the employee. So this is the same form the employee will see and use in order to file with their taxes, though technically they don't need it to file with their taxes. It's really used if they have coverage for only part of the year, or they're not sure what month they were covered by which employer if they change jobs. So part 1 is pretty simple. It's just the employer or their employee, and all of their information. From box 7 over is the name of the employer. So that's going to be your information there. Part 2 is where things get a little more complex. Part 2 is our employee offer of coverage. So box 14 is our offer of coverage code, and we're going to go over those in just a minute. Box 15 is our employee required contribution. And then box 16 is our safe harbor code. And that's going to be the same safe harbor code that was used on the 1094-C form. So we'll go over those in just a minute as well. A big thing to look at here is box 15. If your employees had the same contribution amount all of last year, then in box 15, you're going to put in the contribution for your lowest cost plan to the employees. So what we mean by that is that if you offer, say, 3 medical plans, and your first medical plan costs the employee $100 a month, your second would cost them $250 a month, and the third costs them a whopping $500 a month, you're going to put $100 into here because that is the actual required contribution of the lowest cost plan. Additionally, if an employee is adding spouses, dependents, or families onto the plan, you're still going to use the lowest required contribution for the employee-only plan. This does not take into account dependents or spouses when the IRS does these calculations for our large groups. Now, part 3 of this is going to be used for our folks that are on self-funded plans or on pools. So if you are in a pool or you're self-funded, you should have received a report in the last few weeks showing you everybody who was on the plan for the last year. In this box, you're going to put everyone on who is not the employee. So if you have an employee and family, you're going to fill this out completely for everybody in the family. You're also going to check the boxes under D for if this person was covered for all 12 months or for each of the individual months that said person was covered. So if they were there all year, you can just check that first box that says all 12 months right here. And if not, then you'll kind of have to play leapfrog from box to box to box, deciding on which one that they actually were there for. Now, page 2 of this form is really more instructions, and this has the offer of coverages for lines 14 through 16, and we're going to go over those in more detail here in just a few moments, so we're not going to worry about those just now. But in the event you are going and filling out these forms and you get confused on what we talked about, there's a bit of a refresher there for you. Page 3 continues your covered individuals, so there's plenty of space in the event the employee has a huge family. And we do see that from time to time, so if you need it, it's there for you. So from here, what we're going to do is we're going to dive right into that Part 2 employee offer and coverage. Now, before I move forward into there, are there any questions on the 1095C?
Not at the moment.
Perfect. So there are 9 codes that can be used in Part 2 of the 1095C. Code 1A is a minimum essential coverage providing minimum value offered to full-time employees with employee contribution for self-only coverage equal to or less than 9.5% of the single federal poverty line. In English, that means if your employees spent less than $94.05 per month last year, you can use this code. And these codes, just so that we are back on the same page, are going to go into line 14 here. These are the offer of coverage codes that we're discussing. So when we're talking about these offer of coverage, just know that they all go into that line 14. And if they had it for all 12 months, you'll use that first column. And if not, you'll have to fill it out for every single month that they had coverage. Now, Code 1B, minimum essential coverage providing minimum value offered to employee only, no dependent coverage. Thankfully for all of our clients, we don't have a single client that is offering employee-only coverage. Now, folks may be taking employee-only, but because you as an employer allow spouses, children, and family to come on, 1B does not apply. Same thing with Code 1C, minimum essential coverage providing minimum value offered to employee and dependents. That would imply children, but not spouses. Again, none of the companies that we have with us as a brokerage offer coverage that does not include spouses. We're going to continue on with these codes. 1D means that you offer it to the employee and the spouse, but not the children. Technically, this isn't legal to do. So we definitely don't have anyone that's offering this in this way. Now, Code 1E is in most of our companies, minimum essential coverage providing minimum essential value to employees and minimum essential coverage offered to dependents and spouse. All of the plans that we sell at this time offer minimum essential coverage. For us, there are plans out there that are cheaper. They don't fit into the minimum essential coverage, which means the employee doesn't get out of the individual penalty and the employer doesn't get out of the shared responsibility. They're kind of pointless to sell, to be honest. But for most everybody filling out these forms, if you offered coverage and your employee took that coverage, no matter what level of coverage they took, you're going to use Code 1E in line 14 of the 1095C. So moving forward, Code 1F. And was there a question or?
No question.
Okay, perfect. Just want to make sure I didn't cut anyone off. 1F, minimum essential coverage not providing minimum value offered to employee and at least minimum essential coverage offered to dependents and spouse. I'm not even sure how you would get a plan to do that. 1G, offerage of coverage to employee who was not a full-time employee for any month and enrolled in self-insured coverage for one or more months of the calendar year. This would be for, we do have some carriers that offer self-employed or self-funded coverage that allows 1099 employees on. So that would be something like this. Or you have companies like Uber. Uber has drivers that are all 1099 but is now looking at having to do health insurance for them because of their size. They would be using code 1G in a situation like that. If you have a contractor that's come in for 3 months and under their contract you're required to give them insurance, code 1G is one that you would use. And then code 1H, no offer of coverage, employee not offered any health coverage or offered coverage that's not minimum essential coverage, which may include 1 or more months in which the individual is not an employee. This is a code that you're going to use if you have someone who works for you and is on your plan to say April, and then they quit. You would continue to use this box for the rest of the year to let the IRS know, I didn't offer them coverage because they're not an employee. Now moving forward on this, code 1I was available last year. It is gone this year. The IRS just has reserved on it. So that's not one you want to use. We've got a lot of fire districts. It's not for your reserve members. It just means the IRS is planning to use this for something else later on in the future. What that is, I don't know. Code 1J, minimum essential coverage providing minimum value offered to you and conditionally offered to your spouse, and no coverage offered to dependents. There are certain companies, we tend to see this in the larger company segment, who offer coverage to the employee and spouse as long as the spouse does not have coverage available through their employer. If the spouse joins this plan and has coverage through their employer, they typically charge the spouse a fee or a higher rate. So that's what this code would be used for. And that's the same thing for code 1K, minimum essential coverage providing minimum value offered to you and conditionally offered to your spouse, but this means you're also offering it to the dependents as well. So for all of our companies right now, we don't have anyone who's doing a conditional offer. And honestly, unless you're self-funded, there's really no reason to do it. If you're fully funded, those claims aren't really going to affect you too much unless you've got a very large company. And if you're self-funded, then yes, those claims could hurt you, and adding a conditional offer to spouses could be a good way to go.
And
last code.
What are the conditions that you can include?
So basically, you can say to the employees, your spouse can come on our plan as long as they don't have coverage through their employer.
Okay. So okay.
Yeah, that's a conditional offer. So code 1L was a qualifying offer of transition relief. This code is also gone this year. So those are the two big changes. Code 1I and 1L of this section of the 1095C are now gone. So next we're going to look at the 4980H safe harbor codes. And these are the codes that go into box 16 of the 1095C. Again, to be used in Part 2, Question 16 of the 1095C form, when one of the following situations applies. Employee was not employed or was not a full-time employee. The employee enrolled in the minimum essential coverage offered. Employee was in a limited non-assessment period with respect to Section 4980HB. And what that means is your employee is basically in their new hire phase, or if you have variable hour employees, they're in that look-back period. Non-calendar year transition relief applied to the employee. Employer met one of the Section 4980H affordability safe harbors with respect to this employee, or the employer was eligible for the multi-employer interim rule, and that was relied on for the employee. Now, that rule is typically used by folks that have to pay towards union coverage. So if you do have employees that you have to pay towards union coverage on, we'll go over that code in just a moment. So Part 2, line 16, code 2A, employee not employed during the month. Use this code if the employee was not employed on any day of the calendar month. What this means is for folks that have 20 or more employees, you have to offer COBRA. If your employees take COBRA, they're on your group plan, even though they're not one of your employees. You would use code 2A. That is our COBRA code running right there. Code 2B, employee is not a full-time employee. You'd use this code if the employee is not a full-time employee for the month, they didn't enroll in the minimum essential coverage if offered for the month, or for an employee who is a full-time employee and whose offer of coverage ended before the last day of the month solely because the employee terminated employment during the month. So that section right there, what that means is if your plan is set up to end the day the employee's coverage or the employee's employment ends, then you would use code 2B for that last month. For most of our groups, your plan terminates for the employee the last day of the month that they worked, so you're not going to be using code 2B. The other time you can use code 2B is if you have a part-time employee who then becomes full-time. So you have John Smith, who was an employee for you all of last year. He was part-time for January, February, and March, then went full-time in April, stayed full-time, and jumped on coverage for those months. For the first 3 months, you're going to use code 2B because he was not full-time at that time, and that's why he was not on the health insurance. Code 2C, employee enrolled in coverage offered. You'd use this code for any month in which the employee enrolled in health coverage offered by the employer for each day of the month, regardless of whether any other code in this code series apply other than 2E. So if code 1G was entered, you're not going to use it if that's in the all box, and you won't use it for COBRA because for COBRA, you're using code 2A. So for most everyone that is on the line or will listen to this recording when we finally publish it, code 2C is what you're going to be using anytime an employee enrolls in your coverage. Now, there are other codes in here that are going to look like they may fit a little bit better, but code 2C is the one that we want to use. Now, 2D, employee in a Section 4980H limited non-assessment period. This is what you're using for your new hires in those first 1 to 3 months that they're not on your coverage. If the employee is in an initial measurement period, that's that new hire period. If you're eligible for the multi-employer relief for this employee, you're going to use code 2E and not 2D. And we'll go over a little bit more of the limited non-assessment periods here in just a moment. But the long and short of that, and let me pull up that slide for us. Long and short of all of this is that the employee is in their waiting period. If the employee is in their waiting period, they're going to use code 2D. It's that simple for any month that they're in the waiting period. If you've got those variable hour employees and you've got a 12-month or a 6-month or a 1-month look back, whatever that time frame is, for all of those months of the look back, you're going to go ahead and put in code 2D. Any questions on the limited non-assessment or this code?
No.
Okay, perfect. This one's usually the one that confuses folks. And 2E, multi-employer interim rule relief. So this is used for a multi-employer arrangement when you've got employees who potentially work for other companies or can work for other companies, and you're all putting money together onto their health plan. Easiest way to understand this is unions. When a union has typically a health plan, they a lot of times will require, and we see this more back east than we do out here, they will typically require the companies to pay towards that medical plan. That's what this is here. So for the most part here in Arizona, we're not going to be using this at all. It's a pretty rare situation for us to see this. Section 2F, or Code 2F, Section 4980H Affordability Form W-2 Safe Harbor. Use this code if the employer used the Form W-2 Wages Safe Harbor to determine eligibility. If using the Safe Harbor, it must be used for all months of the calendar year for which the employee is offered coverage. Now, this is one of the codes that can be used if you have an employee who waived coverage from your group plan because they say they have an individual plan or they're on a spouse's plan. Use code 2F. For all of our groups, we've already gone through and double-checked the W-2 Safe Harbor for you. And how this works is that the employee share of coverage for the lowest cost plan cannot be more than 9.66% of their gross wages. So code 2F can be used for anyone who waived coverage because they say they have other coverage, they didn't want coverage, whatever the reason is, you can use code 2F. And the big reason you want to use this code, and there is one other code that we'll look at that can also fit into this, the big reason you want to use this code is so that if that employee goes to the IRS and says, oh no, my employer doesn't offer me coverage that fits my affordability, I should get a subsidy. And they get a subsidy, you're not getting hit with penalties because that person told the IRS they didn't have affordable coverage. This form and this code protects you from that. Now the next one, code 2G, section 4980H, affordability on the federal poverty line safe harbor. This is if your employee is paying less than that $94 per month towards the cost of care. So if you're only charging the employees $20 or $25 per pay period, you can use code 2G for the entire year and call it a day. And let me clarify that. With 2G, same as 2F, you're going to use this for anybody who waives coverage. So we've already got the code that we've used for anyone who enrolled on coverage. We'll go back to that real quick. That's 2C here. So anyone who has enrolled in coverage for any month of the year, code 2C is used for that month. If they were on your coverage for the entire year, code 2C is what you want to use. If that person waived coverage, code 2F, if you're using your W-2 safe harbor, code 2G, if you charge them less than $94 per month for the lowest cost plan. And along these lines, code 2H can also be used because this is your rate of pay safe harbor. Again, for 2016, that rate of pay safe harbor is 9.66% of the gross income for the plan year. For 2017, it's 9.69%. So you get a little bit of an increase there that you can charge the employees a little bit more to help the company's bottom line. So 2F, 2G, or 2H for the folks that have waived coverage in order to protect your company from potential fines under the Affordable Care Act. And those fines can get pretty steep, upwards of $1,000 a day on some, $3,000 one-time fines on certain things, and they typically become cumulative, meaning that they stack together and they look at all of your employees as a whole when they assess the fine, not just the one employee who may have gotten a subsidy because coverage wasn't affordable under what they had used. Last code on this Part 2 Safe Harbor codes was code 2I. This code as well is not being used. The IRS doesn't like the I codes this year, so they're easily being just tossed to the curb. Are there any questions on the Safe Harbor codes or which ones you may or may not need to use this year?
So, Brandon, so these codes would go on part 2 of the form, and you can, okay, so that would be along box 14 or 16?
16. The Safe Harbor code's going to 16.
Okay.
Yep. So the codes, the 1 codes go into box 14. The 2 codes go into box 16.
Okay, perfect. Thank you.
Ready? Yep. So last big thing for this year, just so everyone knows, penalties for not filing. In the event you just decide, there's a new administration, I'm not going to bother filing these this year. Failure to even file a correct information return on these, $260 for each one that's missing, and the total penalty for the calendar year cannot exceed $3.193 million. Now that's for sending it to the IRS. The other side of that is there's a failure to provide a correct payee statement. Also, $260 for each statement for which the failure occurs, and that penalty as well cannot exceed $3.193 million in a calendar year. Now the nice thing the IRS has thrown out there, penalties may be waived if the failure was due to reasonable cause and not willful neglect. So what that means is if you send these forms in and you give a good, honest-to-God try to make them work, and they're just wrong, the IRS may not penalize you for it. What we've typically seen, and we've only had one company that had this happen to them last year, they sent the forms out, thought they did them right, and the IRS said, no, these are wrong. Send them back to them and said, just do them again and send them back. That's it. No penalties involved. Just, hey, try again. So big thing here is to make sure that you at least do the forms and get them sent to the IRS in a timely manner so that if they do try to assess the penalties, you can say, hey, I tried. I know they're wrong, but I got confused in your regulations. And you'll probably get those penalties waived. So other than that, that really is the long and short of the 6055 and 6056 for this year. Do we have any questions on the reporting or how any of this works?
For those of us that have outsourced the reporting requirement, are we supposed to be getting a summary so that we can ensure that they're, that our company is following the right codes, that we've provided enough information to them?
Depending on who you outsourced it to, I would assume that that third party is going to go ahead and give you some kind of a report to let you know that it was done properly. My recommendation on something along those lines would be to check through the contract that you signed when you put it in place with them to make sure that the biggest thing is that the responsibility is shifting away from you. Because if they make a mistake, I would hate to see your company on the hook for it. Either way, the IRS is going to come after your company, but a third party that is doing this service should be guaranteeing their work on the service, or they should be willing to pay the penalties for you.
Okay. That makes sense.
Yep. Anything else I can try to help you with on this?
No, thank you.
No problem. Well, I appreciate you joining me today. I'm going to let you get back to your day. Of course, if you have any questions, comments, or concerns, feel free to let us know. You can reach us via phone, 928-526-5691, or toll-free 800-359-5176. But I appreciate your time today. You have a wonderful afternoon.
Thank you. You too.
Thanks. Bye now.
Bye-bye.